Thank you, Andrew. Ladies and gentlemen, thank you for coming out today. It's been a great event so far, so thank you to CPM and ACRS for putting on this event. I think we've learned a lot in terms of interacting with customers, in terms of brand activation. I guess I've been asked to take a little bit of a different perspective on the retail environment, which is to kind of take a step back and look at the broader economic trends that are ultimately affecting us all as retailers and as suppliers to retail. Ultimately, what's happening in the broader economy, we're all somewhat hostage to, unfortunately, and we do see a lot of it in the news. We see a lot, particularly negative, but there's clearly a balance across the broader economy. So I wanted to go through some of those broader trends today, try and make some sense of those from what's I guess most important to the retail sector, and then talk about some of the thought leadership that Deloitte's been putting out in the retail space lately in terms of the globalisation of retail and navigating the digital divide as well. So I guess starting in looking at the broader economic environment, it is, as always, a challenging economic environment for retail. At the moment we're seeing, across the broader Australian economy, we're seeing jobs growth which is reasonably slow. We're seeing the unemployment rate has drifted up over the past year. We're seeing messages that wages growth is at the lowest pace that we've seen for 15 years. And ultimately those things, employment and wages, are really the building blocks of people's capacity to spend. So if those are not growing strongly, then it is a challenging environment for retail. But then against that, we also see that over the past year, over the past 18 months, overall retail sales growth has actually been reasonably solid. It's actually been better in the past little while than it's been since the global financial crisis. And a lot of that has to do with cheap credit. We've seen interest rates come down and people have responded to that. We've seen people's willingness to borrow money and to spend from that borrowing has lifted over the past 18 months. And we've also seen a particularly strong impact through asset prices, and here we're talking particularly share market and property prices, particularly in Sydney and Melbourne. And that's had an effect on people's, in some cases, people's income in terms of borrowing against those asset price gains. And it's also had some effect on confidence or willingness to spend. And so for that willingness to perhaps save less for the future than people may otherwise have done, because people are safer in the knowledge that their main asset, their house, has appreciated in value. So if we think of those key drivers of late, cheaper credit, rising asset prices, and some running down of household savings, they have been supportive for retail, but they're not the best foundations on which to have sustainable spending growth going forward. So we have to put some question marks over those key drivers and what's likely to happen going forward. The other element of the housing dimension is that because house prices have been lifting so strongly, we've seen a real pickup both in new housing activity, new houses being built, and also in houses being traded. So a lot more housing sales on the market. When people move into new houses, when people move from one house to another, that tends to bring with it a fair degree of retail spending with it in household goods, furniture, white goods, major household items. So we are seeing that as a major driver at the moment for the past year and probably for the next year for household goods retailers. The cycle is certainly in favour of household goods retailers at the moment. If we look at, I guess, stepping, there's a range of economic indicators, but if you look at what is the broadest measure of income growth, the broadest measure for retailers, it's really GDP growth or income growth across the whole economy. And what we've got on the chart here is looking at Australia's income growth over the past 25 years and then looking into the future, that rate of growth year on year. And we can look at a few different phases. This is really the environment that retailers are working to. Ultimately, sales growth is going to be somewhat regulated by income growth. Not every year, because people can run down their savings, but over time that's true. And we went through a period through the 90s and early 2000s where that income growth was actually pretty steady. We had, it moved around a bit, but after the recession in the early 90s, we had income growth at about 5.5%, 6% per annum, reasonably steady year on year. And for retailers, that's a great environment to work in. I mean, if you know that your broad market is going to be growing by 6% year on year, that's great for planning. It means that people have room to grow. There's room for new competitors to come in and take some of that market without necessarily displacing existing competitors. We then went to a period through the early 2000s and then also even post-GFC where that accelerated. That went up to a benchmark of around 7% per year. And some of the drivers there were not... some of it was within the Australian environment of people running down their savings, borrowing more, the link to strong house price growth. We can see on that chart a period of, around 2003, 2007, stronger periods of house price growth helped accelerate spending growth over those periods of time. But also a lot of it was driven by what is now Australia's major trading partner, which is China. The industrialisation of China, the impact that that's had on Australia's economy by lifting the prices of the commodity exports that Australia sells, and also encouraging an unprecedented level of investment in Australia. So we went through a period then when the Australian economy essentially went into overdrive. Stronger activity, stronger price growth, really good for retail as well. We've got income growth 7% year on year. What's happened since then, and in fact, not just now, it's actually happened over the past couple of years, is that those commodity prices have come down. China hasn't gone away as a really important driver of the global economy, but it's the industrial dimension of it has shifted somewhat, and that's been to the detriment of Australia. So that income growth that we were seeing, 7% per year, you look at the last blue line there, it's now about 4.5% to 5% per year because we're not getting that boost from export income that we were getting in the past. We're not quite getting the rundown of savings that we were getting in the past. And we're also somewhat running into headwinds of an ageing population, and so labour income growth is not as strong. Now, I guess whether this chart is good news or bad news kind of depends on your perceptions, your sort of preconceived notions in looking at it. I've had people look at this chart and think, I know this is terrible. We're moving down from 7% to 4.5% growth year on year. That's we're used to a much faster growth environment. How are we going to survive in that slower growth environment? And then I've had other people say to me, David, 4.5% growth per year. I mean, so to be almost in disbelief that they can't believe that it's going to be that strong because everything we hear about the economy is everything's going backwards, and to think that there's still market growth there. 4.5% per year is for some people hard to fathom. So I guess depending on your previous views, it may be somewhat reassuring that there is, even though we are seeing that pullback from essentially what might have been the glory period for Australia 3 or 4 years ago when we were selling our commodities for enormous prices, this massive income transfer. We've moved away from that. But we would still see market growth going forward. We still have population growth in Australia, about 1.5% per year. We don't see that. You don't see that across all developed countries. You don't see that across Europe. In Japan, you have population declining. In Australia, you still have pretty solid population growth, and we still have those linkages to what will be the fastest growing major economies in the world, being China and India. That's not to say that will be uniformly fast growth over time. There certainly will be hiccups, and we're seeing a degree of that now through China's share market. But over time, there's still a long path to go for industrialisation for China. There's still a long path to go to raising living standards in India. There's between now and 2050, hundreds of millions of consumers, of people will join the middle income group in China and India over that period. So there's an enormous demand push that will happen over that time. Australia having linkages to that will protect us somewhat. But just looking at, I guess, the short-term period, the environment we're dealing with now, we've gone from a period where we've had that stronger income growth. Clearly, jobs growth is more stagnant now. But what are we seeing? We're seeing some pricing effects start to come in. We're seeing, interest rates have been cut this year in Australia and cut in other major economies. We're seeing energy prices have come right down. And that's an input to many of the suppliers to the retail sector and the retail sector itself. And we're seeing the Australian currency has come down a long way, so nearly 30% over the past 2 years. That's a pretty significant competitive shift. And for Australian retailers in competing with online retail from overseas, even though products are often sourced from overseas and still subject to those currency effects, there's the perception that the lower Australian dollar means it might, products become better value in Australia. When the Australian dollar was parity with the US dollar, there seemed to be a consumer mind shift that now's the time to look overseas. Now's the time to increase online shopping. So those pricing effects are there and will help to support the Australian economy and to some extent retail in the short term. What else is happening, and it really partly explains what we're seeing in asset prices, is that we need to keep in mind that Australia is a country which relies on foreign investment or foreign funds into Australia to support our standard of living. So year on year, Australia runs a current account deficit, so we import funds from the rest of the world. We borrow from the rest of the world in one form or another, either borrowing through debt or we have foreign investment coming into Australia, purchasing assets or supporting businesses. And that remains the case. But what we've seen, what's changed over the past couple of years is the form of that foreign investment has changed somewhat. And we've gone just in the past year or in 2013-14 from the US being Australia's biggest source of foreign investment to China being Australia's biggest source of foreign investment. And that's partly the growth in China's economy, partly it's regulatory as China has allowed more funds to flow overseas. But there has been a big shift up, and the data there is for 2013-14. Last year we don't have the full year data in, but that trend has certainly continued and into this year as well. And we can, we're seeing now pretty extreme volatility in share markets. We're seeing China's share market as a daily news event. Money being pulled out of there. There's a fair bet that a lot of those funds will then be directed overseas into perhaps what's seen as safer investments. So that flow of funds to Australia is important, but the direction of that has changed, and partly that's important because the Chinese flow of investments into Australia has been more focused on property and real estate than what we've seen from investment from the US and UK and Europe. So we've seen a situation where housing prices, particularly in Melbourne and Sydney, have detached from underlying income growth. So what should housing be worth over time? Well, as with anything, it's people's willingness to pay. But ultimately, that willingness to pay is somewhat regulated by capacity to pay. So you would think that underlying housing price growth over time should be somewhat regulated by income growth. And that's tended to be true, but it can it can detach for periods of time, and we're seeing that at the moment. That's been good news for retail. It's been good news for retail, particularly the household goods part of retail, but it's not a sustainable it's not a sustainable footing going forward. So at some point, and it may be delayed because we're going to see possibly further foreign investment coming into Australia in the short term, looking at property. but at some point those two lines will close again, the blue line being house prices, the green line being national income. And over that time, that's going to be a bit of a hiccup for, I guess, the broader Australian economy, but also the retail sector. So future direction for retail. So, the key drivers have been cheap finance, rising asset prices, and a rundown of household saving. Not the most sustainable basis. Each of those, well, not each of them, cheap finance is still going to be with us for quite some time, but the asset price channel and the rundown of savings are probably going to be petering out fairly soon. Against that, we would see some likelihood that jobs growth will pick up, and partly there's a story around the depreciation in the Australian dollar that I showed on the chart earlier as helping to support jobs growth. We're already seeing it in some sectors. We've had a pretty strong last 18 months in tourism in Australia. Nearly 10% pickup in international visitor arrivals. So pretty significant growth there, and that tends to be a sector such as retail, which is quite labour intensive. So there's areas that will be supportive of the Australian economy in the short term, but in terms of looking through the cycle, it's likely that last year was perhaps the short-term peak in the retail cycle. 2015-16 retail growth moving down, 2016-17 moving down somewhat again before we then start to see we work through that kind of asset price channel and work through to the underlying drivers for retail. And we can see there on the chart just kind of visualises the retail growth story over time, going through from the current period being a recent high, well short of what we saw over the 2000s, but then likely to be moving down somewhat over the next little while. And then the next year, in terms of category of retailer, household goods. So in the current financial year, still expected to see the strongest growth, but we're talking about growth of about 4.5% in sales. In the past year, it's been in the order of about 9%. So that coming down, partly that's still that housing activity that I mentioned earlier. Housing starts have actually increased very significantly. That will take some time to come through. There'll be some further complementary retail spending in household goods as that occurs over the next year. But then we would see that dipping and perhaps the food, the food, non-foods comparison that food retail starts to pick up once more after that. So the underlying economic environment, remains somewhat challenging. I guess another thing that we're seeing, across Deloitte is looking globally. As a global firm, we do look at the reach of retailers globally, and we put out a report on which looks at the top 250 global retailers on an annual basis, and you can download this from the Deloitte website. And our Global Powers of Retailing report shows that of those top 250 retailers globally by value of turnover, there's currently only 37 of those that are operating in Australia. And when I saw that, I was somewhat surprised. We do have an increasingly global economy. We have Australian consumers looking overseas to purchase products. So a lot of purchases online from some of those global retailers, but those that have an actual presence, on the ground presence in Australia, 37. And that's actually been lifting over the past couple of years. So some of those that have established, Williams Sonoma, Abercrombie & Finch, H&M, Uniqlo, Forever 21, over the past couple of years have established a presence in Australia, which they didn't have previously. But to me, I think there's still enormous potential for that to change over time. These are very large companies that currently don't have an active footprint in Australia. And if another dimension of that is if you look at the top 250, only 8 of those companies are Chinese companies. And none of those 8 have a presence in Australia at the moment. So if thinking of, well, the world's second largest economy, likely to have pretty significant growth over the next 15 years, albeit may go through a fair hiccup in the next little while. Should there only be 8 in the top 250? I would have thought 9. I would have thought there'd be more, and that's looking through that message of the information on Chinese investment, outward investment over time. Increasingly looking at Australia. I think it's only a matter of time before that footprint gets expanded as well. Of those that are operating in Australia at the moment, so around half have their origin in the US. So of the 37, around half from the US. There's a reasonably broad mix amongst the others. Only 5% with Australian origin, so essentially 2 retailers. Australia only has 2 in the top 250 globally, Wesfarmers and Woolworths. They come in quite high. Woolworths 18th, Wesfarmers 22nd. So these are big companies globally, but then across the rest of the top 50, there's not an Australian a retailer of Australian origin within that. What are some of the? I guess we've talked a lot about innovation, and it's certainly true that the leading global retailers are not standing still. They are embracing innovation as well, and we're seeing that a number of the global retailers are investing heavily in their own innovation labs, and partly there's also a recognition that in order to be innovative, stay relevant to the consumer, there's a need for retailers to have the right skill set, either themselves or in partnership with other organisations. And then in terms of thinking through, well, how are those sort of trends, those competitive pressures affecting the Australian retail environment? We've seen for a few years now that there has been pretty solid productivity growth through the Australian retail sector. So whether it's through digital channels, whether it's through more efficient point of sale, economising on store staff, we have seen for a time that Australia's retail output, our turnover, has been rising, albeit more slowly, but rising over the past few years. But the use of labour, so hours worked for employees, has been somewhat stagnant. So there has been a drive by Australian retailers to lift productivity over time, and that does seem to be apparent from the overall data. I'm conscious we're nearly out of time, but I'd just like to finish on mentioning some other research that Deloitte has done recently, which is looking at the digital divide and looking at the undertaking a survey of Australian consumers and their usage of digital technology as part of as part of their shopping. And I guess as has been mentioned a number of times today, not just the traditional view of online retail as a separate entity, but digital in enhancing on-store sales. And it's been interesting that survey showed that looking at the percentage of Australians who use digital as part of their shopping trip, 65% said that they did do some research or have some interaction with digital before their shopping purchase. And Alex mentioned the pre-purchase research. Gal talked about the red laser app during the purchase. So 31% of consumers having some digital interaction during their shopping trip. Perhaps checking prices, doing research as they undertake their purchases, and 9% afterwards, perhaps undertaking some points of comparison. And that's seen across a wide range of categories. So electronics, automotive, books and music, furniture, baby and toddler are categories that are the most influenced by digital, primarily to search and access product information and product prices over time. And why is this important? For retailers, it's also apparent from the survey information that those people who are doing their research digitally are more likely to actually convert to actual sales rather than just be window shopping customers. So So the probability that someone who's had no digital influence who's walking to a store and actually purchases something is 62% conversion rate. But that lifts quite significantly if there is a digital influence before or during the shopping journey. So I guess it's saying that information is important to consumers and it is helping them to actually make the decision to purchase. And where are we in terms of that digital influence? I guess one of the interesting things on the research is that while there's been a view that Australian retailers have been over the past few years perhaps reasonably slow to adapt to online and digital channels, at least initially, Australian shoppers don't seem to be lagging or not significantly on that, in that the digital influence profile, that 2/3 of consumers doing research beforehand was similar to what's showing up in the US and Canada, and actually ahead of results that are showing up from consumers in Europe. So Australia consumers are on a path towards greater use of digital. That seems to have further to go. So look, just to sum up, it's certainly true that technology continues to rapidly change the retail game. For retailers, standing still in this environment is not an option. And the challenges are significant, both from the global environment, where there's a large number of global retailers who are not yet active in Australia, and the overall economic environment, which in the short term is likely to pose some challenges as well. Thank you, everyone. Enjoy your day.